Afternoon or morning, depending on where you're joining us from, and welcome everyone. I'm Will Henry. I'm a partner in our corporate group at Thompson Hine. I do primarily M&A, which will be the thrust of our presentation today. My co-presenters and panelists today, which I'm grateful to have attending, are Brendan Igo, who's the Managing Director at Argonite Partners, an investment bank based out of Cleveland, Ohio. Rajiv Khurana, the Chief Legal Officer at Apex FinTech Solutions, he's based out of Chicago. And then Nick Norwood, the Senior Director of Corporate Development at Bright Spring Health Services based out of Louisville. I'd like to welcome you to today's webinar. This is the fifth in a series of webinars examining what the shift in presidential power could mean for the country. Today, we'll be discussing the opportunities and challenges shaping the M&A landscape in President Trump's second term. Before we begin, if you'll tolerate a few housekeeping items as I read from the script. Today's program is being recorded and we'll send you a link within the next few days in case you want to watch it again. This presentation is intended for the general information of individuals and organizations on matters of current interest. The thoughts and opinions expressed today are those of the individual panel members only and do not necessarily reflect the opinions of the panel members' clients, employers, affiliates, or Thompson Hine. The content shouldn't be taken as advice, as the views expressed here are for informational purposes only. If you have any questions during the webinar, you can use the question box located in the control panel on the right side of your screen. We'll answer as many of the questions as we can at the end of the webinar. Since it's a panel, even if you raise your hand, we'll probably keep it to just the group of us four to help sort of moderate it. But then, of course, with about 5-10 minutes left, we'll answer those questions. CLE credit for today's webinar is pending. Please be sure to complete the verification of attendance survey. The link to the survey is posted in the chat. We'll also paste the link in the chat at the end of the program, and I'll announce the attendance tracking code at the end of the program. And then finally, in the handout panel, you can also download a copy of the PowerPoint slides and the bios of today's speakers. Again, thank you for your interest. And if you have any questions as we go along, again, you can use the question box. So thank you again for everyone attending. This session is about sort of our best projections of what M&A will look like over the next 4 or 10 years, but especially as part of President Trump's new administration. So with that, we'll just talk through the agenda. So first, we've already done our introduction, but first we'll actually focus on the immediate past. So what the Biden presidency looked like, including emerging from COVID, the increase in interest rates, inflation considerations, and also CHIPS, Inflation Reduction Act, and the like. Next, we'll go to all the way back to President Trump's first term from 2016 to 2020, and just talk about considerations, the zero interest rate environment, and other elements associated with that. Next, we'll go to the current day, so President Trump's second administration, what we've seen so far in the first month and a couple days, what we project over the coming year, and what the environment looks like. And then finally, in terms of sort of the considering President Trump's presidency, just other opportunities and challenges as they may exist globally. And then finally, I do like to end with predictions. None of these are binding, as the disclaimer states, and any other opportunities we may consider, but just sort of fun to talk about what we might think the world will look like. And again, the design of this panel, and I'm appreciative of our three guests, was intentional. So we have someone who is in-house as a lawyer, thinking about it from a legal standpoint, investment banker, and Brennan looking at just sort of the opportunities on sell sides, and then Nick as the internal business development guy who does a number of acquisitive opportunities, or looked at them as in the course of his career, just getting those different perspectives we thought would be useful for the group. I'll disclaim again the apolitical approach. I'll just add to the fact that none of us represent the views of our organizations, that we're not going to make predictions as to the 2028 election or try to make judgments as to current president, past presidents, that type of thing. We're just trying to look at the consequences and the elements of presidencies in their own eras. I did want to just throw in the slide to throw in the Simpsons reference for those who enjoy it, that we do collectively welcome our robot overlords should AI overtake the world, but that'll be fine. So first, we'll do President Biden. Whoops, so I can manage the slides. Just sort of discussing M&A over the last 4 years. So I'll start off with Brennan, just to kick it to you. What have you seen in the market in terms of COVID, tax incentives, inflation, all those types of things?
Yeah. Well, thanks for having me on the panel, first of all. I think looking back at the Biden years, it was a bit of a roller coaster as you think back on it. I mean, entering at the height of COVID, kind of peak ZERP environment, putting more money into the system on top of that, then has inflation begin to appear, and then you have rising interest rates later in his term. So thinking as somebody who's representing smaller businesses, helping them come to market and sell them, we need to make sure we take on deals that can get done. And that's about balancing seller and buyer expectations. And you had kind of peak seller expectations early in the presidency, and then later on, interest rates growing, just as we get some kind of normalization, because every business almost either experienced some kind of peak or valley due to COVID. And it's very difficult to normalize that and figure out what a company's worth. And unless you're one of those companies that was selling off, a hockey stick and able to capture that lightning in a bottle, just as we started getting some normalcy of revenue or growth, we're hit with higher interest rates and the end of ZIRP and just kind of a little more tepid M&A environment. So I think that's going to continue, and we talk more about the next presidency. But also, on the regulatory front, you had the FTC chair and Lena Khan, who was slowing down deal volume at the higher end, which did trickle down, not so much to our clients, but to the funding environment, which had an effect on us. So.
That's good. And then Rajiv, can you speak a little bit maybe to that bifurcation, active M&A market first part, less active market? What types of
absolutely. I think where I sit and the kinds of companies that we tend to acquire or look to acquire, I look at it as sort of COVID and call 2021. Everything's gangbusters and rising tide raises all boats. Tons of VC money flowing in, those sorts of things. Everybody's making money hand over fist, or at least taking in money hand over fist. You see the downturn or speed bump, whatever you call it, in 2022. Tide washes out. I think you see a lot of assets on sale because the VC funding has dried up with the rising rates and risk-free rate, going at 5%, plus a lot of losses that VC had taken on 2020, 2021 assets, which means that perhaps they're not willing to double down and continue funding, which I think, created in some spaces a little bit of a sale, right? If folks hadn't been able to get to scale, they hadn't been able to generate meaningful revenue, but perhaps the technology was good, or the people were good, or there was some other part that was really enticing. Once you cut through the upside of 2021, assets started to look pretty interesting, and especially if you could bring forth the element that business didn't have, right? So if you're a buyer at scale, and you see a business that, hey, it's a great idea, great technology, they just never got to scale because the funding ran out or whatnot, it's a really great opportunity to pick up an asset at a reasonable valuation and then inject your scale into the asset and see it take off. That, I would say, is sort of the biggest thing we had seen sort of throughout the Biden administration was prices really high, and then it was like a switch flipped and prices came crashing down.
And Rajiv, to that point, did you see an increase in not just assets that finally learned that they couldn't get the inflated valuations of 2020, 2021, but also distressed assets? Were there opportunities in that just as a consequence of as fundamentally less funding?
What we saw, like the distressed assets, to the extent that they made it that far, at that point were pretty distressed, right? And it's one thing to go out and buy scratch and dent. It's another to pick up a good asset at a discount, right? And they each come with their own hair and their own difficulties. I think from where we sit, sure, sometimes distressed assets can be a real opportunity, but you've really got to evaluate, why is this asset distressed, and is my management team or where I sit in that ecosystem good enough to basically turn this around in addition to doing your day job. And that's sort of the calculus that you have to take into account. I think for us, Biden administration didn't just have a lot of ups and downs in terms of prices and interest rates, but the regulatory environment was particularly challenging. The Gensler SEC, we're a fintech focused on investing, so a lot of our interactions come from the SEC or FINRA, and that made it a more challenging environment, right? I think there was a lot more regulation by enforcement. The rules sort of shifted um, every few months or so, or as soon as somebody found a different way to skin the cat, that might be closed off or not necessarily as readily available anymore. So I think having this stability of maybe it's the Trump administration, if you call that stable, but at least at the regulatory level for us makes a big difference as well.
Interesting. And then Nick, to both Brendan's and Rajiv's comments, it seems like there's a trend, which I saw as well, that there's a lot of opportunity in inflated valuations. First part of his presidency, certainly less so the second part of his presidency. As an in-house corporate development person, how did you sort of modify your strategy relative to acquisitions? And then to Rajiv's point, I know you're in the healthcare space. How is regulatory just in terms of dealing with that on a day-to-day basis?
Yeah, thanks, Will, and appreciate being part of the panel today. So, I think it was an interesting environment while the interest rates were low. At the beginning there, there's a lot of PE focus on certain segments of, looking at this with a healthcare lens that drove valuations to kind of crazy levels for certain areas. Pediatric autism was very hot for a period of time, as where it was home health and hospice, and valuations went crazy for a period of time. So I think from our approach, we just had to make sure we were very disciplined on what we were willing to pay, and staying focused on that regardless of what the market was driving. I would say also, it was an interesting diligence environment, I would say, just given all the COVID impacts and census normalization we saw in the healthcare space. That was definitely an area of scrutiny for us, and you definitely had to sanity check what a lot of sellers would put out there in terms of pro forma adjustments that could exist, and what is the true EBITDA, and that was a key focus for us.
And I guess associated with that, I think you touched on it, but how were earnouts treated? Were they fundamental to your business? Was it more or less frequent as things moved on, or is it just something that you would commonly or uncommonly see?
Yeah, we definitely had to get creative in certain areas of valuation, because I think there was certain pro forma adjustments that we're going to see a recovery from COVID, and it's going to look like this, which is very much a moving target or difficult to diligence. So I think contingent payments and earnouts definitely became part of our more normalized playbook for certain acquisition targets. For others, we didn't, but I think we saw a higher frequency of use because of those impacts of COVID.
Mm-hmm. That's fair. And then Brendan, just to close out this chapter, did you see that as well, just in sell-side deals, that sellers were like delighted to be overpaid the first part, and then the second part of his presidency were looking to say, well, let's do earnouts to bridge the gap?
Exactly. That's how you bridge the seller-buyer valuation gap. And I was going to say, we're having those conversations a lot earlier in processes around who's the seller here, and is it somebody who's pragmatic and realizes where the market is and we can get a deal done, or is it maybe a small business owner who heard at the country club that his friend sold his business for 12 times and he wants that in a 6 times environment. That's a big gap, but if you can get to within a couple turns, you can usually get there with an earnout or some kind of structure.
Makes sense. All right, so let's keep going back and go to President Trump's first term. Rajiv, we'll start with you. What did you see? I know you were at your previous position then, but just in terms of M&A activity generally, the zero interest rates, the regulatory environment, all of that.
Look, I think for the first Trump term, I think everybody spent the first sort of year just sort of scratching their heads saying, wow, is this real? But look, we obviously in the first Trump term, we saw a SPAC boom. We saw capital markets really open up. There was just it was greenfield, and it's hard to disassociate, I think, the first Trump term from COVID and from the outset of COVID. I think there were, it's at the time seemed like some really smart moves were being made, and perhaps looking back at it, people would say maybe those weren't the greatest things. But I think from a regulatory perspective, I think the SEC leadership was very capital formation focused. Um, Deals were getting done. Capital markets were very liquid and very deep. But obviously, when COVID came in, just call it first quarter 2020, really reshaped, frankly, a lot of the world, right? I think everybody would struggle to say, "Hey, what was I doing in November of 2019?" So it's kind of hard to really look back at that period pre-COVID, but Trump 1.0, and have anything sort of objective to say.
That's an interesting point because I agree with you from my perspective, right? Just the markets being as frothy as they were in 17, 18, 19, and then it all just suddenly came to a stop in the spring. At the time, did because we didn't know if Trump was going to win a second term then or Biden was going to win, was there any way of accounting for that or adjusting for the uncertainty, or was it just we don't know?
I don't think so. I mean, not to jump too far ahead, but it's like we're having this sort of internal discussion about, well, would you have been able to predict that Trump would win the second term? At what point could you have said, "Hey, I think Trump might win, or a Republican might win who's sort of like Trump, and should we be making business decisions looking that far out?" And I think now it's some people would like to say, "Oh, of course he was going to win," or "We should have thought a lot harder about that concept." But the fact of the matter is, look, for better or worse, we spent the last 4 years talking about January 6th and people going to jail. We talked about President Trump being convicted on multiple felony counts. Uh, it was completely, I would speculate, and I don't know what the Kalshi betting markets would show, but I would speculate that at some point it was a wild long shot for Trump to win. And to prognosticate and think about, okay, what should we do, or how should we change how we run our business? I think that's a bridge too far.
Mm-hmm. That's fair. And then, Nick, to Rajiv's point about just sort of the frothy markets and then just the COVID uncertainty, my experience that the second part of 2020 was exceptionally busy, in part maybe in the face of the uncertainty that Rajiv's talking about. But what did you see? How did it affect your strategy? And then just more broadly, since we're talking Trump's first presidency, what was your experience overall to the extent you can remember the pre-COVID days?
Yeah, I think to Rajiv's point, it's hard to delineate between, pre-COVID times and post, and it kind of blends together. I think our strategy was generally unchanged. We were very active in M&A, and I think there was a lot of tailwinds that were really helpful because of COVID. Certainly more scrutiny, as I already mentioned, but there was definitely tailwinds in the healthcare space that kept activity flowing. There was enhanced rates in certain provider segments. There's all the PPP funds that occur that help bolster people up from that perspective as well. So I think we were still, our strategy, we were trying to be agile, but I think we were still pressing forward with trying to remain as active as possible in our pipeline.
Mm-hmm. And then to Rashid's point, sort of the long-term outlook versus short-term outlook, has that sustained? What's your perspective, even as you reflect upon the COVID era and the end of Trump's first presidency? What's the outlook in terms of M&A or strategy or growth in terms of just addressing the market?
Yeah, I think we try to look, into the near future as best we can, but there's certainly an inherent uncertainty in acquisitions. Obviously, you try to do the diligence the best you can and plan integration the best you can to mitigate those risks, but there's natural uncertainty in the activity itself. So I think we're going to continue down the path of trying to be bullish on M&A, and I think there's going to be more and more activity in Trump 2.0. I think we're going to see more and more things come to market. We're starting to see that, and more activity, and I think that's going to pick up. I think we're pretty bullish overall.
That's a good theme as we'll move into the next part shortly. Before we do, just Brennan, to sort of close this out for you, can you speak to, I believe you represent more sellers than buyers, but the seller psychology throughout Trump's first presidency, buyer behavior, and then, how has that influenced the outlook of sellers that you deal with?
Yeah, I think I agree. Trump's presidency gets clouded with a lot of memories of COVID, but 3/4 of it was pre-COVID, right? And if you think back to that time, you had, like you said, deregulation, you had lowering tax rates, you had the Tax Cuts and Jobs Act, which importantly reduced gave you accelerated depreciation. And I think we're still benefiting from that. We could talk more, sunsetting, but may come back. But I think companies overall, CapEx is in a good place. Yeah, still ZERP going on, so the market was humming and valuations were good, and I think seller and buyer expectations, to my earlier point, were somewhat more aligned. Obviously, COVID threw a wrench in all of that, but times for M&A markets were pretty good.
Mm-hmm. So I like the optimism theme that each of you are sort of speak to, and so let's use that as a way to talk about President Trump 2.0. Nick, we'll start with you since you mentioned it last, but can you speak to sort of what the outlook is like? You can refrain from making predictions unless you prefer, because that'll be on the next slide, but what's the climate like? What are sellers that you're dealing with like? Legal diligence, whatever sort of comes to mind as key things you're thinking about in the first couple months of Trump's presidency.
I think we're seeing a decent amount of activity as we enter 2025. It seems like there are, at least in our space, in the healthcare space, I support pharmacy in particular, long-term care pharmacy, infusion pharmacy. It just seems like just a really hot market, and a lot of things are coming to market, and there's a lot of activity and things that, in our view are sizable to what we've done historically. So it's interesting, everything coming out of that. I think, not to try to predict or look in the future, and I know that might be later in the discussion, I think the hardest part is probably not getting wound up in probably the unpredictability of Trump 2.0 and everything that hits the mainstream media and things that are said off the cuff versus, trying to lock yourself into what will become reality as best you can view it, and what will actually make it through in terms of what gets passed into law by Congress and actually makes it through the machine versus things that are said off the cuff and creates a hyperbolic environment.
Mm-hmm. That's fair. And Brennan, to Nick's point, just sort of dealing with the uncertainty, are there specific industries that you're seeing? Because I think you work across multiple industries that are more sensitive. So, government funding, something that's relying on government contracting, other industries, is there any difference?
Yeah, I think obviously anything that's tied to government spending, and you got to look kind of a few layers beneath the surface there. You're going to have some questions coming out of DOGE and just decreases in spending. I always like to think of things and talk about the difference between risk and uncertainty, right? And the market or markets can quantify and are comfortable with risk, like that's what they do on a day-to-day basis. But uncertainty is something that's more difficult to quantify, and you just don't know what's going to happen. I think to Nick's point, yeah, Trump brings a lot of uncertainty as far as what he's going to say next and what might happen. But if you can look through that, there's some stability there to come. I think in the short term, just coming out of the election and having some certainty around who's going to be in office, we're seeing a nice backlog of M&A activity building up. And we may talk about this later when we get to predictions, but and from some conversations I've been having, I think 2025 should be a good year, but I think it's going to be back-end weighted because these things take some time to develop.
Mm-hmm. And then Rajiv, how do you, and the conceptualization of risk versus uncertainty is interesting to me. How do you think of it at a corporate level, just and how you advise your internal clients?
Yeah, actually, I'll get to that. But one thing I wanted to talk about, I think that's sort of relevant here, but not on the slide, is the zero interest rates. And I'll call zero interest rate versus the higher for longer approach, right? And if you think about this long stretch of zero interest rates, how many business ideas did you hear about that they sounded really good, but then you dismiss and be like, that doesn't work because interest rates are at zero. And or that might work, but where you're not earning any yield on cash or very limited yield, that's not that great. Now you flip into this environment where you're at a higher rate for longer, it starts to sort of skew people's thinking. And those ideas that maybe weren't that interesting in a zero rate environment become a lot more interesting. And now back to your point, Will, about sort of uncertainty versus risk, the question then becomes how much longer is the rate environment going to be where the 10 years, at 4+%? And do we think about acquiring businesses or starting lines of business that are sort of more dependent on a higher rate or are much more attractive at a higher rate only for a recession or something unthinkable to happen where we now go back into an ultra low interest rate period? And that could really just, turn that business upside down and say, well, that business again that works in a 4%, 4.5% 10-year environment doesn't work at 1 to 50 basis points. And when you think about risk in that way, I think that you really need to have prudent risk management that evaluates sort of the value of this business, not just in today's environment, but multiple different scenarios. Are there pieces that become more valuable that we're not seeing because of the higher interest rates? Are there counter-cyclical forces that could make that business successful even in a low rate environment? It really forces folks to think about all the different possibilities and get creative about value and value in different environments and in transitory periods as well. Because remember, for a while we heard this mantra of, oh, the inflation, it's transitory, right? And the higher rates are just sort of in effect that going to be transitory. And here we are, it's February of 25, and again, 10 years pushing 4.5%. Looks like it's here to stay. So we'll see. I think that if you look at things through a rate environment about what you can do with cash versus on a risk-free basis, you'll come out with some pretty interesting projects and prospects.
No, that's interesting because I think about 2017, 2018, it seemed like interest rates were just going to be zero for however long mattered to any of us.
Right.
Do I take your point that it seems like interest rates are at least here to stay for the foreseeable future, just given the inflation uncertainty. Is there any thought that that we may end up going back to that environment, or that and this sort of goes to prediction slide a little bit, but that there might be technologies or other elements that will allow us to sort of get past this and lower interest rates and thus increase our risk tolerance?
It's interesting when you think about risk tolerance versus rates. I mean, everybody at first blush says, look, there's risk-free rates, in excess of 4.5%. Why would I take any risk? But you still need to generate some differential against what everybody else can do, against sort of, you need to create some alpha. So there will always be a level of risk taking, and I think it's about that risk management on the back end and knowing effectively when to take your shot, right? When to get in the game and when to fold. But I'm a firm believer that rates will stay higher. We'll probably hit some kind of Goldilocks point where call it somewhere in the 3.5 to low 4s, that people are incented enough to take prudent risk, right? Measured risk that invest in great companies and great people. But it's also the flip side where you're not chasing, the next crypto project or, whatever pie in the sky thing exists in your industry. And I think that's really healthy. I'd love to see us get there, but I do think we've got a little bit of runway to do that.
Mm-hmm. I like the framing of prudent risk. Nick, can you speak a little bit to sort of how you approach risk, uncertainty, even seller behavior as they look to their markets and to their opportunities to sell?
Yeah, thanks, Will. So we're definitely trying to, make sure we're protecting ourselves in the most prudent way possible with either how we structure transactions. Earlier in the onset, we talked about protecting our downside with, earnouts or contingent payments, or if there's certain uncertainty with a particular transaction we're looking at, we can tie some of that valuation to a future payment to offset some of that downside risk, and then doing the same in a go forward environment here. I think we might look to more earnouts and contingent payments as well, just to target dependent. I think it's something we're going to keep in our playbook going forward.
Is there, at least as far as you can tell, sort of as a result of 2023, 2024 being slower M&A markets, Nick, sort of a backlog of sellers that are out there, or just available opportunities, or is it they're still stuck in this kind of wave of uncertainty that exists relative to interest rates and presidencies?
I think it's segment dependent, of course. I mean, depending on your industry. Speaking to my experience with a healthcare lens, I mean, long-term care pharmacy, there's certainly impacts of the IRA that we're seeing more and more of. That was something that started in 2024. There's a list of drugs that CMS negotiated that's going to happen in 2025, and I think that's put some pressure on the industry. I think that's probably put pressure on some of your smaller, more independent providers out there that is probably telling them, hey, it's time, I need to figure something out as this stuff goes into effect and has, potential margin compression on their business.
That's fair. And then Brennan, to both Rashiv's and Nick's points, what have you seen in terms of, I know you started the risk versus uncertainty, but seller behavior, backlogs, opportunities, and since Nick raised it, right, the Inflation Reduction Act, how have those factors affected behavior over the last year and going forward?
Yeah, I'll try to make a few points. As far as the backlog, we've definitely seen a piling up of backlog, often from deals that we worked on the last few years that just didn't get done for whatever reason, couldn't get buyer and seller to align. We put it on the back burner, and a year or two later it comes back. And a lot of times that is a seller who's got a number in mind that they're trying to hit to sell, and the multiple's not there, so they just have to grow into it in terms of the base EBITDA or whatever the multiple's based on. So we're to the backlog point. I think not only new deals coming out, but the old ones are coming off the shelf. And then just tying a few things together on the risk and uncertainty. I think Rajiv was saying there are certain business models that work well in high rate environments. Obviously, there are other business models or businesses that are born out of low rate environments. And I think you saw just, my background, we're generalists, but I like to spend a lot of time in software and tech. So we see this. You see a lot of companies that got funded or were born out of this 17 to 21 type ZIRP environment that never probably should have existed in the first place. And now they're burning cash and looking for a home, and either need to go do some kind of capital raise or more likely get acquired or just shut down. So these companies either need to downsize to kind of become default alive and then be sellable from a reasonable standpoint, or it's pretty weak to come out to the market if you're burning cash and need to sell by a certain time. But there are people kind of hanging around the hoop trying to do those deals. I was going to go into kind of risk and inflation and growth and tie that all together, but maybe we come back to that as we move on here.
That's fair. And I guess one follow up to all of that, just to your point about the ZIRP companies, to the extent you deal with them, how do investors' mentalities affect looking to sell those companies? So for example, does someone who bought into a company that would only exist because of ZIRP in 2018, do they have less patience because they fear that this higher interest rate mechanic will just kill the business over the next couple of years, or is it they're just willing to take that type of risk?
Yeah, I mean, we're having those conversations when we're representing a seller. We're having the conversations a lot earlier in the process of like, what's the situation here? If it's VC funded, how much funding has gone in? What was the last valuation round? Are they burning cash? Is there a deadline? And we try to be pretty transparent about that unless it hurts the process. Versus, is the seller an individual or is the company, owned by PE who's going to be pretty pragmatic? obviously we try to avoid those situations where you're selling from a point of weakness. But yeah, buyers kind of are pretty upfront about, are we wasting our time here? Is this deal real?
All right, well, I think let's move to sort of other considerations, as I'll say. So every presidency has the drive of the president and their own initiative, but just thinking about the world in which we're in and how inseparable that is from President Trump's presidency. Rajiv, just to start with you, I have the list on the slide, right? China's emergence, potential wars and uncertainty, have to put crypto on any slide given Doge, and just artificial intelligence. Are these factors relevant to your business, or are there other ones that are on the list that are influencing how you all think about risk and opportunity?
I think that these are all hyper relevant to our business, and I'm sure there are others, but I think the other one is probably going to revolve around the regulatory environment, right? Just who gets appointed, what staff is still left at the agencies, the pace or lack thereof of agency rulemaking. But as we look at this, obviously cryptocurrency will be really interesting. We're not in the crypto business, but it does have an impact on investing generally and people's risk appetite. And we saw a big Bitcoin run up from election day through, call it maybe last night, right? When Bitcoin broke 90,000. I think you could couple that and look at equity volumes were probably a little bit elevated. Um, retail investors at least, were pretty enthusiastic about markets and taking on more risk. So I look at if people are investing in crypto, to me, that means equity markets are risk on. And generally, you're going to see a lot more activity in those markets. Obviously, the AI, quantum computing, data center play, Project Stargate, I think that's going to be super relevant for any business, right? Just even from a pure CapEx, physical infrastructure, revitalization of certain areas. I think that's all going to really, really have an impact, not just during the Trump administration, but for years to come. We're seeing all of that.
Mm-hmm. And Nick, same question to you. Do any of these key considerations jump out to you, or are they just all, as Rajiv noted, important? Are there any others that either excite you or concern you?
Yeah, I think there's an interplay to all of them, and they're all impactful. I mean, I think what Rajiv mentioned on the regulatory environment and how it works under Trump 2.0 with antitrust review and how those work on, those larger scale deals that meet those thresholds, and what that office's collective approach will be on those transactions will be really interesting and a key item to watch. And, definitely would harp on the AI component as well. I think that'll impact. I don't know if there will be anyone who's untouched by that and its evolution, whether positive or negative. I think that's going to be impacting everybody in some capacity.
That's fair. And then Brennan, same question to you.
Yeah, I think obviously they're all significant, but the one that jumps off the page is AI. I think if you're not thinking about that as a company, no matter what industry you're in, you're falling behind. I don't know if I'm the only one. When you sent these questions for us for this panel, first thing I did was run through AI, and every time I use it, I'm blown away by the quality and the information depth that I need to be using this across my organization. So I think to Rajiv's point, obviously there's trade-offs between investing in M&A or CapEx or internal projects. There's a return on capital for all of those. And I think you saw a lot of the big tech companies saying, well, M&A is somewhat shut down recently, so we're just going to spend our money on CapEx and buy a ton of AI chips, and NVIDIA benefited from that. I think we all benefited from that. But no, I think everybody's got to focus on AI. I had a number of predictions, so I'm getting ahead of myself when we get to the end here. But one prediction will be, I think you're going to see kind of a cross-industry AI deal along the lines of like an AOL Time Warner back in the day, where some non-tech company makes a big splash by buying into AI.
I like the predictions, and I will have more on that. I will say, with respect to all of these opportunities, whenever I go into like Twitter or New York Times or whatever news source, I feel like I'm attacked by all of the things that could possibly go wrong in the world, and that may just be the stuff that I curate on my feed. To that negativistic point, or before we get into predictions, Nick, is there anything among these key considerations or otherwise that you would present as the biggest threat or the biggest thing that keeps you up at night as you think about M&A opportunities?
Yeah, I think, I don't know that it keeps me up at night, but just, some of the uncertainty with Doge and, things that are, government contract related and things like that, if that impacts your business, I mean, I think that would be a concern for sure. I don't think that, necessarily impacts us, directly, but I think some of the volatility with what you see in the mainstream news related to all those activities is just creates uncertainty, and how people react to that, positively or negatively, it will be interesting.
Mm-hmm. And then Brennan, same to you. What's your biggest concern? Not to imply, Nick, that you can't sleep at night normally, just to be fair.
Well, like I said, I focus a lot of time on software, and I think outside of AI, I see a lot of headwinds in the software industry, just companies scaling back their OpEx and not wanting to be tied to cookie cutter products. And I think to Nick's point, just the unwinding of federal spending and the downstream effects that we may not be able to predict, we could be in for a bit of a reset over the next 12 to 24 months.
And then Rajiv, same question to you. What's your biggest concern if you can pick one?
My biggest concern would probably be that people anticipate a lot of change. People anticipate that the world's going to look a certain way, and either it doesn't happen nearly as quickly as they think it will, or it doesn't happen at all, right? Whatever you think is going to happen, maybe you've oriented yourself or your business or how you run your business in that way, anticipating something, and for whatever reason, politics, geopolitical events, economic conditions, it doesn't happen. And I think we live in a world with a lot of uncertainty these days. Uncertainty that I'd say is unanticipated uncertainty, right? There's always some level of uncertainty, but I think we're seeing things and patterns of behavior that people aren't necessarily used to or don't necessarily have calibration on how to react or how to take that, which then drives decision making that is poor, right? Not well thought out, reactive versus being on the front foot. And I think that's really, the biggest existential risk that I'm thinking about.
Yeah, the unanticipated uncertainty is an interesting conceptualization. Nick, do you see any of that, or sort of whether that's seller behavior, just as you think about, AI could take over the world tomorrow, right? We could have AGI by the end of June, right? As some projections have had, but alternatively, to Rajiv's point, it may take 10 years for the infrastructure or regulations to allow for any significant changes. How do you deal with the generalized uncertainty in the face of change?
Yeah, I think I'd agree that things take time, and that commentary that was already said. I mean, I think you have to, have a thoughtful strategy and try to stick to it. While you want to have some flexibility and be agile, it's important not to be spooked by things that pop up and, by the marketplace, and not to behave irrationally. I think we saw, going back to, the earlier part of the presentation, we were talking about presidential agendas and tax changes and things like that. I remember when everyone was very panicked about long-term capital gains rates and that changing, and that created an artificial fire drill for certain sellers to make certain things happen by year end. I can't recall if that was end of 2020 or end of 2021 when those were going to be impactful, but I think it's just staying the course with your strategy and being thoughtful.
And then Brennan, just the same question, but how do you account for risk in terms of seller behavior?
Yeah, I think it's kind of like the old Donald Rumsfeld unknown unknowns versus known unknowns, and you can plan for the known unknowns, but for the unknown ones, all you can really do is build adaptability and agility into your processes, and think that goes back to a lot of the discussion earlier around lessons from COVID and having agile supply chains, and what companies can do to be adaptable, and also in terms of deal structuring and having earnouts or contingent payments that are able to be adapted to changing outcomes.
Makes sense. So now we move to what I was thinking would be my favorite part of the program. I implore those that are that want to comment or have questions, feel free in the comment box to add your own predictions. But we figured we'll go through with and start with one obvious prediction for 2025, to the extent there is such a thing. One less obvious prediction beyond that, relating to Trump's presidency or otherwise, and then we'll close with other thoughts, and we'll include any other predictions that are particularly interesting and that we catch in the comments. So I'll start with you, Brennan. What's one obvious prediction that you would make for this year? It can be as broad as you'd like, as long as it somehow attaches to M&A.
Sure. I've alluded to a couple of these, but I'll say on the obvious side, I think we're going to have a big 2025 in M&A, and I think it's going to be back half weighted. I mean, I see that in my business, and I see that in most conversations I have with private equity groups or other investment banks. Everybody's kind of expecting that. On the less obvious side, I already gave you mine about it.
I'll hold you on the less obvious side, if that's okay. But I do want to press you on the why would it be back half weighted? Is it just all of the factors we talked about? Anything in particular?
I think it's largely the timing of deals being launched post-election. So if you got some certainty in November, December, it takes us investment bankers 2 or 3 months to put a book together, and then we're in the market maybe starting in Q2, and then it takes another 4 to 6 months to get deals done. I mean, that's kind of a long timeline, but just the nature of the M&A process. If you start a bunch of deals in November 2024, they're going to close back half 25.
And then Rajiv, what's your one obvious prediction for 2025?
I'm going to take the other side of Brennan's prediction. I don't think there's going to be an M&A boom in 2025. I think that there will be too much oscillation in the markets and uncertainty about our greener pastures ahead in 26 and 27, that sellers are going to maybe get a little greedy and want buyers to pay up for that anticipated growth, and folks just won't get there.
And then Nick, you get to break the tie. What's your obvious prediction that seems not so obvious?
Oh, I know. Well, since we're split, maybe it's not obvious, but I guess I'm going to side with Brennan on this. I think that the activity and the deal flow is picking up, and I think it's going to ramp up more speed as we continue on into 2025, and I think it'll continue into 2026. I think the one caveat would be is if we see a turn on inflation and interest rates, if that trends negatively, like that could be impactful, but very much TBD on when that would happen.
Mm-hmm. And although I've moderated most of this panel, I'd offer my one obvious prediction is going to be more narrow, which is I predict we'll have at least one government shutdown, potentially as soon as 2 weeks from now. And I do think that that'll have a meaningful, the uncertainty of that will have its own cadence in terms of the outcome on M&A. Some may just move forward and be agnostic to it, but especially businesses that rely on government funding, that type of thing, how they deal with that, and whether it's just one shutdown or multiple shutdowns, I think could have a significant effect on things. So, all right. So one less obvious prediction. We'll go in the same order. Brennan, what do you have?
I mentioned the cross industry prediction. I guess another one would be we talked about the SPAC craze of several years ago. I don't think you see that coming back, but I have heard rumblings of investors looking at kind of zombie public companies that are more old companies with some NOLs that they can buy and use to unlock value. So I'm not sure how big that strategy can get, but I've been hearing more about it lately.
Then Rajiv, what do you have?
Yeah, I guess mine's a little more nuanced, and I'm not sure. I think the interplay to M&A is a little further, but I think the accredited investor rules are going to change this year. There was a good op-ed in the Washington Post from the CEO of Robinhood talking about a number of things, but one of them I think he advocated for was changing the accredited investor thresholds, noting that, look, right now, retail investors are really shut out from investing in early stage companies, which is a very recent phenomenon because companies are waiting and waiting and waiting to go public, to the point where there's very little upside left for retail or public market investors. I could definitely see the Trump administration and the SEC in its newly reconstituted form try and open that up, so that investors have access to quote unquote private companies much earlier in the process. And I think that'll make for an interesting dynamic when you think about, do we need to sell, or should we merge, or should we, what kind of capital market growth activity could we undertake if we can reach this broad swath of retail investors who are looking to dip their toe into sort of more assets and traditional public equities.
And does the increase in potential retail investors, if you lower, and probably not eliminate, but if you lower the threshold for accredited investors, is there, I know that the existence of the rule in Blue Sky was to prevent people from investing in, I think Brendan used the word like zombie companies, right? Do you think that that has sort of an additional cadence once you introduce the risk profile of investors?
Maybe, but I think, at first blush, what will happen is there will be a flight to quality, right? Because everyone's sort of unknown. I don't know these folks, and they're not public, they're not traded on the New York Stock Exchange, but I've heard about SpaceX or I've heard about Anthropic, and absolutely I want to be in that. And then there will obviously be the fringes where folks fall for effectively scams, right? And they buy shares in a zombie company that's going nowhere. But I think that will be the odd case or infrequent at the beginning. I think at the beginning, in the first, call it 24 months, you'll see a lot of high quality companies or high potential companies potentially come to market with an offering for private shares, if you will, in those companies, and retail or even individual, non-high net worth, but not general retail, will take a liking to that, and hopefully keep those companies growing and provide a little bit of competition for capital, whether it's swaying off a VC round or a PE buyout or some kind of other injection. Maybe it'll be individual investors getting a piece of that action.
And then Nick, what's your one less obvious prediction for beyond 2025?
I think just change will be slower, as we talk about the Trump administration, and it's probably the same way with a lot of past administrations, whether, their agenda is aggressive on whatever topic you want to pick, whether it's tax changes or healthcare changes. I think there's just a big chasm between, the political rhetoric and posturing that you see day to day, and then what actually comes to fruition and what actually gets passed in the law and gets through Congress. I think there's going to be just a big difference there, and the change will be slower than what is talked about.
I guess to unpack that a little bit, when you say change will be slower, maybe I'm too optimistic. I feel like AI and just the technological developments that may bear will bring about faster change. You're talking about like slower implementation of change, or how does that work?
Yeah, I think AI is fast moving. I think that's a fair point. I think maybe more on the political side of things is things just getting through the machine, like maybe big initiatives, or whether it's DOGE or other impacted governmental agencies, that could just be a slower impact than what you see day to day, or what's in the headlines, so to speak.
Mm-hmm. And then I'll offer my one less obvious prediction. I love making this when I talk in front of groups, is I think we'll have a trillionaire by the end of the decade. I know Musk is in the lead at 350 billion. It changes a couple billion every day, which is a big problem to have. But a lot of the investment that exists is very binary, right? So Amazon, Meta, Google, Microsoft, they're all they're not making any money from AI, but they're putting hundreds of billions of dollars into AI, and one of those things will probably pop, whether that's artificial general intelligence or some, it allows the development of some drug or series of drugs. I think there's just too much money put into it. I don't know if that means that all of the other companies will fundamentally be losers, right? That there's a binary outcome that everyone will use OpenAI or everyone will use Anthropic, but I think the benefit of whatever technology that is, to me, it's not infeasible, and if not likely, that by the end of the decade, we'll have someone who individually is worth more than $1 trillion, which at that point is something beyond monopoly money. So, and it could be one of us, but I doubt it, but we'll see. You never know. All right, so we're almost at the hour. I'll just give the opportunity, parting thoughts. I think since we did alphabetical from the beginning, if okay, I'll work backwards alphabetical. Nick, do you have any final thoughts to share with the group?
No, just appreciate the time, Will, and participating in the panel. I think looking cautiously optimistic, looking forward to the future, looking forward to the near term when we see deal activity pick up in the near term throughout mid and end of 2025.
Very neat, thank you. And then Rajiv.
Just again, I want to say thanks for having me. It's been a great panel. I guess I'd end it with look, change is constant, and it's really about how we react and continue to evolve in the face of change. I think that's where you'll see the cream rise to the top.
Thank you. And then Brennan.
Yeah, and echo the gratitude for hosting the panel and having us here. But I guess my takeaway is that the M&A flywheel is going to keep turning. I think my entire career looking at the data, everyone's always said there's so much dry powder on the sidelines that needs to be deployed, and M&A is one of the better ways to deploy it. You have your internal initiatives, you have CapEx, you have other trade-offs, but M&A is that one way to make asymmetric bets that can outperform some of these other options. So I'm bullish.
Awesome. So on that positive note, between opportunity, change, and M&A is the linchpin of all that society requires, it's a nice note to end on. So again, thank you very much to our three panelists, Brennan, Rajiv, and Nick. I really appreciate your time and preparation for this and your thoughtful insights. Our next webinar as part of our webinar series will be on March 4th at 2 p.m. Eastern, so a week from today. The next session will cover how the FDA's approaches to regulatory and enforcement issues may change during the second Trump administration. So again, kind of a drill down on some of the regulatory considerations we had. Sessions are held on Tuesdays at 2 p.m. Eastern. Check your inbox for invitations on the upcoming topics, and I hope that you can join us. If you're not currently receiving our updates and invitations, we invite you to go to the Thompson Hine website and register to receive our mailings under the Publications tab. Thank you, everyone, and have a wonderful afternoon or morning, and thanks again, everyone.